I've also seen interviews on the China Insights YouTube channel that are translated into English from Chinese factory owners. And you're talking about labor costs and some of these other costs, parts, materials, plastics are up, but they were talking about their energy costs. And the Chinese government was either forcing some of these factories to shut down since really July of 2020. I think no, it was 2021. I think it was mid 2021 this stuff started. I started seeing news stories in early to mid 2021 that China was shutting down the factories because they had a energy and electricity shortage. So they were diverting the electricity away from the factories. But the cost for these factory owners in China are up 10x for some of these factories. So if their electricity costs, their power costs, their energy costs are up almost 10x compared to factories in other countries, they're not going to be able to export deflation anymore with cheap manufactured Chinese goods.
Yeah, exactly. And there's, I've seen different analysis on why they might be having some of their power problems. I'm not, their market's pretty opaque, so I don't know the full reasons. But there have been estimates, for example, that they might be having groundwater shortages. And of course, most types of power are heavy users of groundwater. They use a lot of water, so you wouldn't, most people wouldn't expect how much water a coal plant uses or a nuclear plant. They use a ton of water, and so it's possible that they've built so much of an industrial base in their country that they're having trouble sourcing water that runs a lot of this power. But whatever the reason is, yeah, they're having power shortages and they're just not, they don't really have the capability in terms of labor or industry to give the world the same disinflationary trend. So, during this whole 25 years, we've had, relatively rapid broad money supply growth in most of the developed world, but you had less inflation growth than you'd expect from that level of money supply growth. And a large part is because it was offset by some of these disinflationary globalization trends. And it's just that whole tranche isn't there anymore. We basically sacrificed, resiliency to have as much efficiency as possible. And now we're kind of paying for that. And now there's an increased view towards resiliency, but that's inflationary. And the way I've described it is that it's not that we shouldn't be shocked by how inflation is going to be high this decade. We should be shocked by how low, official inflation was in the past decade, because a lot of those were these one-time, unusual disinflationary trends that helped us push out a lot of that inflation, and that's just normalizing now. That's just like that. Those unusually disinflationary trends are no longer with us, and so I think that any money supply growth that happens is going to more readily turn into price inflation going forward.
The just-in-time supply chain that the global economy relied on for decades that was working efficiently, it just doesn't work under pandemic. It doesn't work under lockdowns with politicians, bureaucrats, and regulators changing the rules all the time. I speak to a lot of small business owners, and I just hear all these horror stories about their costs rising double digits, so well over 10%, if they can actually find the parts that they need to sell goods and services.
Yeah, and it's also an international security issue, kind of like how Europe is heavily reliant on Russian gas. The United States and Europe are heavily interconnected with China. So if we think it's a big deal how much taking Russia out of the global economy was, or at least trying to, they, other than their energy exposure, they're a very small percentage of global GDP, whereas China is a massive share of global GDP. And basically, it's interconnected with the vast majority of S&P 500 companies. They're a big consumer market, they're a big production market, and so we're so intertwined with them now, that it creates this kind of standoff. I mean, imagine if in the Cold War our supply chains were like completely interlinked with the Soviet Union's. That would have been a very different dynamic. That's basically what we've created now. Here, by the time we got to the 2020s, is that we are highly intertwined with another rising power. And so the two biggest countries in the world have this kind of Cold War type of rivalry between them, but then they're also very, very interlinked in terms of financial markets, manufacturing markets, supply chains, energy, the whole thing.
So I want to transition now to the U.S. federal government's finances, because there is a lot of stagflation. Governments are looking around for new tax revenue. If there is an official government recession, then that means, historically at least, that means lower income taxes, lower capital gains taxes on stocks, bonds, real estate. We've had the crypto crash, although I think it's rallying when we're recording this interview. And then lower sales taxes and lower property taxes for state and local governments. So what do you think the Fed can do can the Fed actually hike interest rates above 3%? Because if they keep hiking rates, aren't they going to break more things? Aren't they going to end up destroying the US Treasury's tax revenues?
I think eventually, yeah. I think that they're not going to be able to tighten as much as they think they will. Kind of like how we've already seen that Japan and Europe have, been unable to tighten really despite this inflation. The Fed has a little bit more room, but I think that they're going to run out of that room. And there's a couple kind of delayed functions. So one is that they issued a lot of treasuries ahead of time, so their TGA account's pretty full, and they got a lot of tax revenue in the past few quarters. And so their coffers are pretty full at the moment, but that's going to be a rather transitory situation because going forward, the U.S. is more reliant on the stock market going up in terms of its tax revenues than many other developed countries. We're a very, externally financed country. We run these big trade deficits, but then a lot of those dollars flow back into our capital markets as foreign investors take those dollars and buy our financial assets. So basically, we are, this big economic engine runs on buying depreciating assets from the rest of the world by selling our appreciating assets, by selling our financial assets, our houses, our stocks, our just claims on corporate debt, things like that. And so, without the foreign bid for constantly going into our markets, and without the stock market was 200% of GDP, now it's down to like 150% of GDP. But either way, it's a very large segment of the economy, and so when you get that going down, that hurts tax revenues quite a bit, both in terms of capital gains, but then also in terms of the wealth effect is so significant for the U.S., more so than less financialized countries. And so when the wealth effect goes down, consumption ceases. We're also seeing that credit markets are tightening up. So corporate the ability to the cost of capital for corporations, especially for junk bonds, is much higher now. The cost of mortgaging a home now, if you were to move or just have a new home, buy a new home for the first time, basically anyone who's not locked in currently and tries to get into real estate, it's much higher than it was for them. Much higher monthly payment for their mortgage than it was a year ago, 2 years ago. And so all of this is going to transit into less economic activity and less tax revenue. And so the U.S. is fine for another couple quarters, but then they're going to start to find that deficits are widening again, while there's not exactly a lot of foreign demand for treasuries. If anything, when the dollar strengthens, the foreign sectors becomes either not net buyers or can outright be net sellers of treasuries. And so I think that market's going to get increasingly liquid and problematic until they have to step in. And it's awkward if there's pretty high inflation and they still have to step into treasury markets. That's basically, that's what you got in the 1940s. That's what we're seeing in Japan and Europe now. And the Fed might be in a similar position where they're stuck monetizing deficits despite the fact that their mandate is supposed to be trying to raise an inflation. And the U.S., even on right now, as they project out for 2022, they're looking at roughly $1 trillion deficit. So it's 4 or 5% of GDP, and that's with unemployment officially at 3.6%. So basically, give it as good as it gets, in trailing numbers, and that's about as small as they can get the deficit. So of course, if you have a recession, that quickly starts to widen. And so I think that they're going to have, but this is kind of a lot of people are focusing on private debt, which is still a big deal. But I think increasingly the story of the 2020s is going to be public debt around the world, Japan, Europe, the United States, and elsewhere.